Hey class, this is Roy again with a video lecture for chapter number 7. We have two parts, so this is part 1. The topic of our chapter 7 is itemized deductions. So we've learned in past chapters the simple tax formula where we have income, all the different ways of making taxable money. Then we subtract out expenses or deductions. These deductions that we deduct right away are called either trade or business deductions or adjustments that we've learned in the previous chapter. And when you subtract out these two types of deductions from your income, you get that important amount called adjusted gross income. And then from the adjusted gross income, we subtract out either the taxpayer's standard deduction or itemized deductions, which again is the topic of our chapter number 7. We also subtract out the personal and dependent exemptions to get the taxable income of our taxpayer. And we multiply this by a tax rate to get the tax liability for the whole year, the income tax liability. Again, our focus is itemized deductions. And if they're much smaller than the standard, you shouldn't waste any time trying to keep track of your itemized. Although you won't know the which is larger unless you do at least have an idea of what the itemized deductions are. Itemized deductions are reported on a Schedule A into these different categories that we'll talk about today. And then you have a total down here that may be limited based upon that AGI number we talked about in previous chapters. So we'll focus on, let's take a closer look here. Medical and dental expenses. And we would just group them together on our records and put the total right here for the so-called out-of-pocket. In other words, you can't include any medical costs here that was reimbursed or paid by the insurance company. But you can't deduct all of this. We're going to reduce it by 10% of the taxpayer's adjusted gross income. So that may leave a smaller amount or maybe even no amount here. We'll also take a look at the taxes you pay, interest you pay, charitable contributions. Even though you don't see a AGI percentage limit here, there is one based upon what you give, cash or non-cash, and who is the charity you give to. There may be a percent limitation, again, not shown directly on this Schedule A. And what you get to deduct is off to the side here in this right-hand column. Casualty and theft losses, we'll cover this in more detail in our next chapter, chapter 8. The last section of the Schedule A is miscellaneous. Really, there's two different parts here. And we'll get into the detail and then eventually total our itemized deductions down here in the last line. So again, the first part of the Schedule A is medical. So let's get into some detail here. Well, before maybe even looking at the detail, medical expenses, medical insurance is really integrated into a lot of our income, especially if you're employed or maybe retire and collecting Social Security benefits. So let's start off here as the taxpayer or even maybe as a patient in terms of medical costs. And what we're doing is getting services from healthcare providers. This is your doctor, dentist, pharmacy, even the costly one like a hospital. And they're not doing their services for free, so you're getting charged and you're paying a hefty medical costs here. Now, hopefully, if you have a big um, healthcare costs, you're going to be covered by health insurance. So let's put the health insurance company over here. Health insurance, really, it's some type of organization. The big ones in Hawaii are HMSA or Kaiser. You can even consider the government that covers retirees with Medicare, TRICARE, CHIP, Medicaid as a health insurance organization. And hopefully the bulk of your healthcare costs is paid by that health insurance. Now, of course, health insurance is not free. Someone has to pay for it. So if you, the taxpayer, is paying for it, what you're paying to that health insurance company is called an insurance premium. And maybe this is one of the medical expenses that you get to deduct on your Schedule A as an itemized deduction. So for most people during their work life, this taxpayer, they're working for an employer, and here you're now the taxpayer employee receiving a wage or salary. And of course, we know that's going to be taxable income that you report on your 1040 every year. But hopefully, your employer, at least here in Hawaii, required by law, if you work more than 20 hours a week, your employer has to cover you with health insurance. And the good employers will pay all of this premium for their employees. Well, there's a formula that the state law requires how much the employers have to pay at a minimum. And it's possible that the employer will also share the costs with the employee. So the employer will withhold the employee share of that healthcare insurance premium and together with their share pay it over to the insurance company. The nice thing about withholding it from the employee's pay is that it reduces the taxable salary, or they can elect to reduce the leftover amount here as the taxable amount to our taxpayer down here. So it's almost like you get a deduction off of the top versus having to claim this premium as a medical expense on the Schedule A, which could be very limited in deducting. Okay, so deduction off the top if it's withheld from um, your paycheck. But you still probably have to pay your healthcare provider anything that's not covered by the health insurance. So sometimes that's called a co-payment or a deductible. Yeah, the leftover payment you gotta pay the healthcare provider. So this could also be possibly a large amount that maybe the taxpayer cannot afford to pay directly. So one way the government tries to provide taxpayer saving for this type of payment is to allow them to withhold from their paycheck something called a flexible spending account or medical savings account or health savings account. So you're diverting more money from your so-called pre-taxed payroll, your paycheck, and then that reduces what's taxable. So now when you incur this type of expense here, this co-payment or deductible, you can ask the trustees of this fund here to reimburse you tax-free for whatever costs out of pocket you had to pay. So keep in mind now what we're looking at as a medical expense deduction on Schedule A is anything that's not reimbursed, not paid by the health insurance. If this amount was reimbursed by your employer or this fund here, none of this could be possibly deductible. Let's say that you're a retiree, so you're now collecting from the Social Security Administration your retirement benefits, and maybe you're paying your share of the Medicare costs. That's called Medicare Part B. The the health insurance, not the Part A, which was being taken out from your paycheck during your work life and not deductible. Yeah, that's sometimes called hospital insurance. But this Part B is like the doctor insurance, and you have to usually take it out from your retirement Social Security benefit. This amount can be used as a deductible medical expense, medical insurance premium. So who can you claim medical expenses for? Definitely for yourself, or if you're filing a joint return for you and your spouse, or medical costs for your dependents. Even if you cannot claim your qualifying relative as a dependent because they make too much money, like we learned back in chapter 2, if they don't pass an income test but pass all the other tests to be claimed as a dependent, you still cannot claim them as a dependent. Except now, if you pay their medical expenses, and the only reason why you cannot claim them as a dependent is because they make too much money. They don't pass the income test. Your payment of their medical expenses can be claimed on your return as an itemized deduction. Or if you have a child with another parent and you're separated or divorced, and that other parent is claiming the child as a dependent, but you pay the medical expenses, the rule is now you can claim those medical costs on your 1040 form as an itemized deduction. So here's some categories of medical expenses that can be claimed. Of course, the main one is you go to the doctor, hospital, dentist, and get some work done or get some drugs. Here, if you pay for the premium, now keep in mind if they deduct this from your paycheck and you reduce your taxable salary, you cannot deduct this premium. Long-term care costs, possibly if you're um, chronically ill, is a medical cost. Also, if you pay insurance for this, a premium for long-term care costs, possibly at least up to certain dollar limits per age, you can treat it as a medical cost. And moving around to your doctor, possibly that cost can be deducted for travel. Um, Keep in mind this insurance costs here, we're talking about as an itemized deduction. But if you incur it as a self-employed taxpayer, you have your own business income, trade or business income, you possibly can claim this not as an itemized deduction, but better yet, claim it as an adjustment as a for AGI deduction um, that we had learned back in the previous chapter. So typically the type of costs you're going to be deducting as medical is when you go to see your doctor or dentist, and whatever they charge you can probably claim. The more difficult ones is if your doctor prescribes you for things to do for general health, like going to a certain location that's maybe better for your health. If it's for general health and not for a specific condition, then that's not a medical deduction, like taking a vacation. It has to be for a specific illness, yeah, or a specific diagnosis or treatment. Then possibly you can claim that type of cost as a medical cost. In Hawaii, I guess in the news you've been hearing how it's now legal to sell marijuana for medical purposes, but because it's still illegal under federal law, you cannot take a deduction for buying medical marijuana. The prescription has to be given by a doctor. In other words, non-prescription drugs like aspirin or vitamins, supplements, the things you can buy off the shelf without a doctor's prescription, those items do not count as deductible medical costs. Things that help you functionally do better medically health-wise, like glasses, contact lenses, hearing aids, all of that is qualified medical costs. Even cosmetic surgery could be deductible if again it's prescribed by a doctor to correct a deformity or some type of disfigurement, not just getting rid of your wrinkles. So you need to move around to get to the doctor, especially if you have to fly to somewhere else to get some specialized prescribed treatment. So the airfare is treated as a medical cost. If you have to drive, even from your home to the doctor's office or going to Long's Drugs to pick up your prescription, if you use your auto, you can claim 17 cents per mile. Or just take a taxi and you can claim the whole thing, or Uber or Lyft. If you have to travel away from home, any meals you incur up to 50%, assuming it's ordinary and not extravagant. In the case of lodging, it's just limited to a maximum of $50 a night. You also can count the cost of travel for another person if you need help. So subject again to these limitations up here per person. If your cost for long-term care meets a condition called chronically ill, where the taxpayer cannot do two of these things at least for 90 days, then the cost of the long-term care is a medical cost you can claim, again subject to our AGI limitation. So if you've taken other accounting classes, you probably have heard of the term capital expenditure. Basically, it's costs that you treat as an asset. And of course, for an asset, maybe you get to depreciate that cost over the lifetime or deduct it when you sell it. But in the case of capitalized medical costs, you can deduct it right away if it qualifies under this exceptions here. In the case of stuff like we talked about eyeglasses, yeah, or wheelchairs or crutches. Again, all of this has to be prescribed by a doctor to be deductible. Now, the big type of cost that can be prescribed by a doctor is to make changes to your home, like putting in a swimming pool or a jacuzzi. Again, this is all prescribed by a doctor. It is deductible to the extent the cost is greater than the increase to the value of that property. Again, it's the difference here, the excess cost over the value being increased that you get to deduct as a medical cost. Stuff to remove barriers like ramps, widening doors, door thresholds, lowering counters for the taxpayer patient. Again, prescribed by the doctor can be deducted as a medical expense. Okay, we just finished this medical dental. Again, the total would go here, out-of-pocket costs, not including any costs paid by the insurance company. Now, any insurance that you paid that had reduced your taxable salary or got reimbursed by one of those flexible spending accounts. And again, your AGI here, taking 10% of it and then subtracting it from the medical costs. You notice this is just one lump sum figure, but you should have records keeping track of all of these costs here. And if you have lots of medical costs, you're going to have lots of medical records to track. And then any leftover then is what's added to the other categories of itemized deductions, where again you total them and you compare them with your standard deduction. And again, if you know your standard deduction is way bigger than your itemized, no sense even keeping track, at least for tax purposes, your medical costs. Let's take a look at the next section that you get to deduct is taxes. Now keep in mind, in our class, what we're trying to do is figure out the federal income taxes. But you don't see that as one of the deductions here. What you do see is any income taxes for paying the state or paying a local government. Here in Hawaii, we only have state income taxes. we don't have any local income taxes. We have other taxes besides income, but not local income taxes. An example of local income tax would be, let's say you live or work in New York City. So definitely you pay a federal income tax, a state, New York State income tax, and a New York City income tax. The New York State and City income tax would be showing here as a deduction. An option to deducting state or local income taxes, here you see the or, is to deduct the state or county sales tax. Okay, and we'll see an example of that later. The other two taxes here, real estate, personal property. Real estate, of course, is the land and anything the land is sitting on. And personal property, not personal use now, but personal property is anything that's not real estate, like all the clothes you're wearing or the automobile you drive. The computer you're using right now is personal property. Real estate and personal property taxes are based upon the value of those items, and you would multiply it by a rate to get the amount of tax you can claim here. Here in Hawaii, we only have real estate taxes. We do not have personal property taxes. Personal property, well, you have a car, right? And don't you pay a fee every year? Well, that's a fee, not a tax. And it's not based upon the value. If you take a look at that annual registration form for your automobile, your part of your registration fee is based upon the weight of your automobile and not the value of the automobile. Here in line 8, where it says other taxes, the main one possibly you'll see here is foreign income taxes. And more times than not, you won't see it here because the better place to claim foreign income taxes is to claim it as a tax credit and not as a deduction. So we'll learn more about credits in a future chapter, I believe our last chapter of the semester. Let's get into a little bit more detail for taxes. So the option for the sales tax right here, most people won't keep track of the sales tax they pay during the year. In fact, Hawaii does not have a sales tax. What we have is called a general excise tax that is charged to the business and not to the consumer like you or me. But it's just customary to pass on this general excise tax to the customer. And the federal government allows the taxpayers here in Hawaii to deduct this passed on tax. Now, most people would not keep track of this, so the government, the IRS, allows an estimated amount to be deducted. So what you'll see in the instruction booklet for the 1040 form is a table or tables full of numbers like this. And this is not the tax rate schedule. This is an estimate for claiming the sales tax. So for Hawaii, what you would do is look up the amount of income you have, including non-taxable income in these ranges. So let's say you have between 50 and 60,000 of income, and your family size is 1, 2, maybe 3 people, maybe 4 people. So right here is the estimated amount of sales taxes you had incurred during the year. If you bought an automobile, it would not be included in here, the sales tax on the automobile. So you can tack on that cost from the sticker to this amount here. But again, keep in mind what you're doing is claiming the larger of the income taxes or the sales tax. And because Hawaii has a relatively higher income tax, we would be claiming this A here, not the B. There are some states, like I guess Texas, Florida, they don't have income taxes, so definitely they want to claim this sales tax deduction. This type of tax probably should have been more explained in detail in the previous chapter because it's a for AGI deduction, whereas Itemized deductions are the so-called from AGI. We're deducting it after calculating AGI. But anyway, the self-employment tax is really um, the Social Security tax on self-employed taxpayers who have their own business, like a Schedule C or a partner in a partnership. And because they're not treated as employees of their own business, they really don't pay the so-called FICA tax. Uh, what they pay is self-employment tax as their Social Security. And because they pay close to, let's see if I can see the amount here, they would calculate their self-employment tax on a Schedule SE. So here's their business income, and they have to pay up to 15.3% of that net business income profits as self-employment tax. Whereas if you're an employee, your Social Security taxes would be half of this rate. But here, the self-employed taxpayer, because they're not employees, they pay the full 15.3%. And this is in addition to the income taxes we're trying to calculate out on the 1040 form. And because this tax is so big, the government allows half of the tax, here's the tax here, half of it, 50%, to be treated as a deduction back on the 1040 form as a for AGI deduction. And there's some calculations here, like this percent, to reduce the business income by this tax. So it's like an algebraic chicken and egg formula to get to this number here. Okay, so that's it's really again 50% self-employment tax deduction. Okay, so go on to part 2 of the video lecture where we continue talking about other categories of itemized deductions.